I'm buying me a single wide. Dave O'Hara about Redlands, Realty and Loan. We're bringing these market updates to keep you informed on mortgage and real estate. About Redlands, Realty.com is where you can get a hold of us at the Contact Us section. And hey, if you appreciate these, then feel free to just smash the thumbs up button in the bottom. Helps us a great deal. Easy for you. Okay, let's get moving. Okay, first off, the recession of 2008, 2010, right in there, was basically mortgage related. Now, when I say that, I mean it was the fact that we, in general, the mortgage industry, sold lots of products that were a little risky. They were not A-paper loans, but these loans were boxed and bundled up with A-paper loans and sold off in bundles to investors, nations, all over. Wall Street couldn't get enough of them, so they kept incentivizing us to sell more and more and more of them. That was a problem, and that was part of the biggest reason in 2008 for the crash and the recession. However, nowadays, the pandemic is the villain, and the mortgage industry is really bolstered up and really taken charge and really helped the economy with refinancing at low rates, with doing cash out refinances, tons of different types of refinances. We did more refinance in 2020 than most any other year. The mortgage and real estate industry is so important to the economy that President-elect Biden even has down payment assistance and other mortgage real estate items on his platform. So it's the first time I can ever remember that a president had something in reference to that right when they were going in. You can check his website and see about it. There's a $15,000 gift of a sort, tax credit to first-time home buyers, but we've gone through pieces of that in previous videos. But very interesting. That leads into the fact that mortgage and real estate is so important in reference to our economy that's why I see the industry is really trying to broaden and open up these guidelines. Nothing like 2008 and 2010, but more like debt to income ratios that are staunch at 43, edging up to 45, and perhaps even 50% for debt to income, because that restricts a lot of borrowers. Number one. Number two, Fannie Mae, Freddie Mac, HUD for sure, National Association of Mortgage Brokers, they've all, in their own separate parts, done what they can and continuing to do what they can to broaden these guidelines to allow for more home buyers to actually own a home. Because, for the first time, or the worst time actually in American history, the gap of wealth is so broad now between what people earn that certainly there's a huge segment of the population that can afford a home, but there's a lot of people that work day in and day out very hard just to make ends meet. There's no way they could save up a down payment. So having down payment assistance programs with income limits, and perhaps not, because there's certainly a few that do not, but helping people to get into the home. We just talked about a home up on Clifton. It was a $520,000 home, and after you're all done with 5% down kind of a thing, the payment would be $2,800. Now, of course, lots of factors go into that, but that's a generality. And a lot of people can afford a $2,800 payment, but they can't afford the $15,000 down. So, understandably, for sure. Okay. Also, widening up, and as an example, is the 3% rule. So, the 3% rule is that the closing costs cannot exceed 3% of the loan amount. Now, this restricts a lot of brokers from actually doing loans, and brokers historically do loans for less than a bank. This is causing these low purchase amount borrowers to go to the big banks for these loans, because the banks don't have to disclose what their money costs, because it's their money, as opposed to a broker has to disclose what that money is costing us. And so they can put the fees into the 3% and rather into the interest rate, and so it doesn't actually get into the 3% calculation. So in effect, that's causing these low value loans to cost more money. So they're looking at doing away with that, or possibly increasing that percentage so that brokers can do those loans as well. Another interesting thing is that the manufactured homes. Now, of course, it's always been a bit of a niche, but a manufactured home loan was only available for double wide or larger. The other guidelines certainly existed, but starting February 1st, Fannie Mae will start accepting single wide manufactured home loans. Now, they still have to be the same guidelines of permanently affixed, listed as real property, and June 15th, 1976 manufacture date or newer, because that's when the HUD red tag was implemented. But that's a fantastic thing, because a single wide generally is less money than a double or triple wide. So they're doing their best to widen the guidelines to let more people in so that more people can be homeowners. And I really appreciate that. I think it's going to be really good for our industry, really good for our economy, good for the population in general. Thanks for joining me. We try to keep these quick. If you liked it, please feel free to smash that thumbs up button and share and subscribe. You can always contact us at aboutredlandsrealty.com. Thank you for attending. I'm Dave O'Hara with About Redlands Realty and Loan.